The current environment is arguably one of the most challenging ever in which to construct portfolios and have confidence in their ability to meet investor objectives and return expectations. Today, investors really need to make a choice when setting risk and return objectives. One, they either need to take on a lot more risk to achieve their targeted return, or two, they need to be prepared to accept lower returns for a given set of risks. No investor likes the idea of accepting lower returns, but in our view, we question whether investors actually understand the implications of taking on more risk to achieve higher returns. Naturally, investors want all of the market upside, but with none of the market downside. And unfortunately, this utopia doesn't exist outside of luck. Investors that have been prepared to take higher risks have benefited from strong returns over recent years, but we think it's dangerous to extrapolate those into the future. As it stands today, markets seem very complacent about valuations and risk. It's really only when you look at the long-term valuations and charts that you realise how expensive markets are relative to any other point in history. And if we're right in our view that cash and bonds are expensive because you've got record low yields, and shares and property are expensive because they're one of the most expensive we've seen in history, then the return implications for a typical moderate, balanced growth or high growth investor are very problematic. Starting valuations do matter when considering our long-term return expectations, and investing into expensive markets rarely works out well for longer term returns. So having clear and realistic expectations is paramount, and investors need to be prepared for potentially what lies ahead. Having unrealistic expectations is really going to set investors up for disappointment. And whilst it might be comforting in the short term, it doesn't prepare us and is likely to disappoint. The harsh reality is that return expectations need to be lowered, and it's going to be very difficult to achieve the types of returns that we've seen in prior decades. So in this environment, investors really need to have realistic expectations and review their overall risk management strategies to ensure that those return expectations can be achieved. Markets are expensive and cycles are real. Whilst they don't repeat precisely, they do rhyme. And buying expensive assets rarely works out well in the long term. So investors really need to focus on where they're being rewarded to take risk. And that involves thinking outside of the box into less traditional asset classes and really asking that question, am I being rewarded to take risk before they allocate capital? We really need to ask, is this time different? And if the answer to that is yes, then investors should be buying this market in anticipation of further market upside. But if the answer is no, this time isn't different, then capital preservation becomes paramount. In our view, it'll be the passive strategies that are tied to the expensive markets that are likely to experience the lower returns going forward, whereas active strategies that can take on active risk but being rewarded for those risks are more likely to achieve the stronger returns going forward. So having a more proactive and active investment strategy is what's required over the coming years. Investors also need to have some downside risk protection built into portfolios, because when markets eventually roll over, it's often too late to put the protection in place after the fact. whilst we may be wrong in the short term and markets can absolutely continue to rise, it's very complacent just to stay invested in the market through either fear of missing out or because there are no other investment alternatives. In our view, that's a strategy that's built on hope rather than sound investment fundamentals. As we mentioned earlier, the current environment's very challenging and one of the most challenging ever that we've had to actually construct portfolios that have the ability to generate the return expectations that we and clients are looking for and have confidence in that outcome. But at Molloy's we embrace that challenge, and it does require investors to think outside of the square and invest into strategies where they are being rewarded to take risk, and that includes strategies and asset classes that are non-traditional and outside of the likes of cash and government bonds and broad-based share markets. Investors really need to focus on what their return objectives are and what type of risk they're willing to take to achieve those return objectives. It's only when looking at long-term valuations that it becomes clear. A better buying opportunity will present, but investors need to overcome the fear of missing out and wait for that better buying opportunity. The Molloy's philosophy is built on patience. Today's environment's very difficult and most investors are ignoring the risk side of the equation.